US Federal Reserve has cut the policy rate by 50 basis points in an emergency meet yesterday. Let's do a three-point analysis of the policy action done and also the outlook going forward. 1. Emergency rate cut. Well, US Fed's policy action reminds about the central bank's emergency response function in the year 2008. In the thick of subprime crisis, emergency meetings were called in and policy rate cuts of more than 25 basis points were pursued. On 22nd of January 2008, US Fed reduced the policy rate by 75 basis points, and on 8 October 2008, post the Lehman collapse, federal funds were also reduced by 50 basis points. US Fed's action comes as on the steps of G7 meeting, which was held yesterday as well, which pushed for a concerted action in response to the coronavirus epidemic and to support the economy going forward. Earlier, Australian Central Bank RBA had also lowered the benchmark policy rate by 25 basis points. Now, in the earlier phase of coronavirus epidemic, monetary easing actions were mainly driven by the Chinese Central Bank. However, as the epidemic has spread beyond Asia with a far-reaching impact of global supply chain and economic activity, therefore coordinated actions by the governments and central banks are on the offing. 2. Interest rate trajectory. Well, US Treasury yield curve, which appeared stabilizing post the trade deal between the US and China, has recently seen a sharp downward shift post the coronavirus epidemic. Unsurprisingly, short-term yields are even weaker given the disinflationary scenario in the near term. Street is also pricing one more rate cut of 25 basis points, possibly in the Fed meet of April 2020. We believe this could happen sooner given the equity and bond market reaction and the base case that epidemic would get worse before stabilizing. 3. What are the key takeaways then? Well, central banks across the world, including the RBI, are expected to announce proactive measures aimed at liquidity support and transmission. The areas which are highly affected by the virus would require more of a medical, administrative, as well as fiscal measures to contain and to recover. However, the areas which are unaffected so far by the epidemic but have a strong trade or supply chain linkages would require measures, both monetary and fiscal, so that credit or liquidity flow breakdown is prevented. Fed is also expected to continue with series of open market operations to provide ample liquidity into the system as well. The key challenge, however, is that there is a limited scope for central banks to act. Most of the advanced countries' central banks have a negative or near zero policy interest rate. US Federal Reserve has also exhausted a good part of ammunition to the trade war. Now, this leaves way for the fiscal policies to take center stage in terms of stimulus measures. In terms of economic impact, a great part of H1 CY20 would be a washout period for a good set of industries and regions. Equity market is also volatile and is expected to remain high as well. Longer the extension of corona epidemic, higher the probability of global recession as well. Now remember, the implied volatility of this nature was last witnessed during Euro debt crisis in 2011 and subprime crisis of 2008.